All right, let's get right into it. Today, we're diving into some really worrying signs coming out of two of the world's biggest government bond markets, Japan and Germany. We're going to break down what's going on and what our source material says it could mean for, well, the entire global financial system.
So let's start with this. This warning right here really sets the stage for everything we're about to talk about. It tells us that a potential threat is brewing in markets that are supposed to be pillars of stability. And you know, when these pillars start to look shaky, it can affect everything, from your pension fund to mortgage rates. The big question is, why are they suddenly looking so shaky?
Okay, before we go any deeper, we have to make sure we're all on the same page with this one key concept, because you're going to hear the word yields a lot. Just remember this, when investors get nervous, they sell government bonds. When they sell, the price of those bonds falls, and as the price falls, the yield, or the return you get, goes up. So, rising yields, that's a big red flag for market stress.
So what's causing all this alarm? Well, it all starts with a pretty surprising development in Germany, a country that, let's be honest, is known for being super frugal and stable. It seems like one single political decision may have just lit a fuse. And here you can see that chain reaction laid out perfectly. It all kicked off when the German government passed a new, much more generous pension bill. Right away, investors looked at that and thought, whoa, that means a lot more spending and a lot more debt in the future. That spooked them. They started selling off German bonds, and, just like we talked about, prices dropped and yields shot way up. And this number just shows you the impact of that one decision. We're talking about German 30-year bond yields, a key benchmark for long-term stability, surging to their highest level in nearly 14 years. I mean, that is a massive move for a market that's supposed to be the bedrock of the entire European financial system. But here's the thing. The situation in Germany isn't just some isolated event. According to the source material, it's actually a symptom of a much bigger issue. The nature of modern money itself, what we call fiat currency. You know, money that's valuable just because the government says it is, not because it's backed by something like gold. Now this is pretty wild. This comparison gets right to the heart of the argument about purchasing power. So back in 1964, the US minimum wage was $1.25 an hour. But get this, because coins back then were made of 90% silver, the actual value of that silver today would be over $52. Compare that to today's federal minimum wage of $7.25. It's a really stark way to see how the value of labor changes. And if you thought that was something, check out this chart. It shows this absolutely massive disparity in who's benefited since then. The minimum wage? Up 580%. Congressional salaries? A bit more, up 773%. But average CEO salaries? They've exploded by an incredible 14,000%. So the crucial point the source makes here is that this kind of system with fiat currency and the inflation that comes with it tends to really benefit people who own assets. Meanwhile, the purchasing power for people who just rely on their labor kind of stagnates or even falls. And that creates this huge growing gap, a problem not just in the US, but really across the whole Western world. This growing gap is putting a ton of pressure on the entire financial system. And next, we're going to look at how this is spreading like wildfire through global bond markets. And hey, if you're finding this explainer valuable, do us a quick favor and hit that like and subscribe button so you don't miss any of our future updates. All right, so this brings us right back to the bond markets, where all these underlying economic pressures are now causing what our source calls a very dangerous feedback loop. The source material we're explaining really doesn't pull any punches. The argument here is that as governments keep promising more and more spending without any sound money to back it up, the bonds they issue become riskier and riskier assets built on what are basically described as empty promises. And what you end up with is this really nasty, vicious circle. See, as yields rise, governments have to pay more interest on their debt. That puts even more pressure on their finances. But at the same time, the banks and pension funds that are supposed to hold these bonds as safe assets, well, they watch the value of those assets fall, which weakens the entire financial system from the inside out. And this is not just a German problem anymore. The stress is absolutely spreading. This brings us back to Japan, the second biggest bond market in the world, where yields are creeping towards 2%, a really critical level for them. We're seeing spillover effects in the UK, and even in the United States, yields are staying stubbornly high, well over 4%, and that's despite recent rate cuts by the Fed. So what's the big takeaway here?
It's that contagion is a very real risk. In our completely interconnected global financial system, heavy selling in Japan and Germany just doesn't stay in Japan and Germany. It's already spilling over, and it's creating a kind of domino effect. All of this leads us to the final and frankly pretty unsettling question posed by the source material. With all these trends picking up speed in the world's biggest markets, is a major government bond crisis on the horizon? And if it is, what comes next? It's a question that leaves all of us watching these markets very, very closely.